Let's get into conversation with Taher Badshah, the CIO at Invesco Mutual Fund, who's joining us on the show now. And Taher, hi, good afternoon. First of all, give us a sense of what you are making of this union budget, especially that it is so heavy on the entire consumption theme. And if this is a theme that you are liking right now, if your stance has changed, or if the budget has made this sector look more favorable to you now.
So for us, I think what we've seen out of the budget is something which is welcome from a portfolio standpoint, because we now have the other side of the economy also, which is probably can have certain attractive features and probably where growth can accelerate. Um, uh, I'm not necessarily of the view that this will have to come at the cost of the investment economy or the investment portion of the portfolio. And therefore, to that extent, up until now, that we were probably confronted with a situation where only one uh, engine or one cylinder was firing. We probably now have the other cylinder firing for us as well from a market standpoint. And therefore, I would like to think that this just broadens up the opportunities for us from a market standpoint in the portfolio. And we can probably look at a portfolio configuration which is somewhat more healthier and more balanced as we go forward. So in that sense, therefore, we believe that this is a welcome budget.
Hi Tahir, this is Shrishti also joining in. So it's a welcome budget indeed. But Tahir, help us understand that which factor you are giving the most weightage on at this point in time. Is it the budget cheer that will drive the markets from here on? Or maybe the concerns on the earnings downgrade still persist, or the overhang related to the tariff sanctions maybe with respect to India-US trade? So which factor do you believe is the most important to watch out for?
So now with the budget done and dusted, and it has served its purpose in terms of recalibrating the economic objectives. Now we obviously, our view, Shashi, has been basically that at an aggregate level, we see 2025 being the first part of 2025 being a slower part from a market standpoint, because we will be confronted with some of these challenges that you mentioned, essentially changes which are happening from an international administration point of view, and the global forces which are trade forces which are at play right now. I think these were some parts of the anticipated factors of the market which we thought would probably come in the way of the market performing in the first half of 2025, and that is what is panning out right now. We are of the view that the second half of the year will probably be the part of the year when we will start making returns. So we go through a dull part of the year where we probably trend downwards, as we are doing today. We also go through a certain amount of time in absolute correction, and then we start picking pace as the earnings cycle then starts to once again revive in towards the second half, or maybe towards the latter part of 2025. So yes, we have been of the view that some of these challenges with regard to downward revision of earnings, global trade forces because of the change in administration in the US, and some of our own local factors will probably be against us in the first half, and then we eventually start to build from there on. So I think in that what is panning out in the market today is consistent with that view. Although I would like to think that the reaction that the market has given over the last few weeks, especially our Indian markets and some of the emerging markets, has been somewhat more brutal than we would have anticipated. We would have probably thought of a more gradual decline in the market in the first half of the year, but here we are. The market has seen a much larger correction in terms of intensity in a shorter period of time. So I think here we settle down and then we gradually build up. I think the bulk of the larger damage which had to happen in the first part of 25 is probably done in my view.
That sounds optimistic, Taher. But going ahead, if you have to get sector specific, what's your view on defense stocks as well as PSU stocks along with capex stocks, capex related names? Because we understand from the budget that the defense allocation has been not in line with what the street was expecting. What's your view on defense and PSUs, and especially also on the capex related front?
So I would like to think that, look, I mean, we have to look at the numbers in the context of the market. And while at an absolute level, we may feel that, and perhaps even for all of us, we may think that the 10% growth which has been allocated for public expenditure in this budget compared to, let's say, the 20-ish which was being allocated for the last 2 years, obviously there's a deceleration to that extent. But when we look at it and juxtapose it in the context of the market, which has already punished many of these industrial names as a result of that. What should be a starting point now? Our starting point now tells us that there is a certain amount of disappointment which has come in and which has probably been priced by the market. And what should we look forward to now is basically the budgeted capex being being spent during the course of the next 6 to 12 months time. So even though the budget allocation may only be 10% higher at 11.2 lakh crores, but can we make sure that the 11 odd lakh crores is probably spent during the course of the year? We had a shortfall in spending in the last year versus the budget estimates by 8 odd percent and 5% in the prior year as well. Can we have a situation where this year we might overshoot our target? Because that probably also is quite possible. So I think what we have to now measure is what do we see in terms of spending from year on, and on a monthly basis, if the numbers budgeted for even FY25 were to be achieved, and then for FY26, I think we are looking at roughly approximately about 95,000 odd crores on public capex being spent over the next 15 odd months, 3 months of this year and the 12 of the subsequent year, versus about 75 odd thousand crores that we spent in the last 12 months. So if you look at it from that relative standpoint, then we are likely to see an acceleration. And if we see that acceleration beyond a particular point, I think market will move away from the fact that it is just a 10% growth allocation for the year as a whole to try and see it from the point of view of the acceleration from 75 to 95, which is quite substantial. And that should have its own implications from a second order and third order multiplier effects in the economy as well. So I think I would like to now at this level, with some of these industrial names having been quite badly hit, would start looking at them a lot more constructively. Of course, we can't call bottoms accurately, as we know. But the thing is that this is a time, like as I said, bulk of the damage which had to be done is probably done. We may see some more of it, but the larger part of that is done. So I think we start taking a more constructive view out there. We try to build some consumption opportunities as well in order to bring in that balance, and we also then try and keep an eye on some of the export-oriented opportunities too, because with the changing order of the world with regard to trade dynamics, there could be some opportunities coming from there as well. So I think we continue to play some part of what we were playing last year and build a few things around it as we see opportunities come up and as things develop during the course of calendar year 25.
So industrials is the place to be. But Taher, I just wanted your take that is there anything that you're reading more into the kind of sanctions and the tariff imposition right now? Because yes, indeed, Mr. Trump has been changing his statements, or rather making changes in terms of the policies, but the tariff imposition on China still persists. They are reaching the deadline. But China is not taking a back seat. It has gone ahead and also announced that they will be imposing the tariff on select commodities. So help us understand that, is there any opportunity that lies for India right now? Because definitely when these tariffs get imposed, there's the consumers are at the weaker end. There's no benefit for any other country. But given this scenario, any sector that you believe that where India can actually benefit from?
So unfortunately, because of the moving parts, we and with the fact that this is not settled till the time it is settled, and the policies are not fully crystallized till they are crystallized, it's very difficult to kind of take a view on that. You can see that there's been a change of stance over a 24-hour period. So clearly it's very difficult to predict. I would rather in this kind of a situation probably wait it out to see as to what exactly transpires and where does it settle. There will be some policies which will be finalized and will be implemented. I think it is better to take a call post that instead of preempting some of these. I think the push and pulls of the US economy are of a reasonably complex order, and there's no simple yes or no as far as tariffs etc. are concerned. Even for China, there is to some extent, like while you do say that 10% is being thought about, but 10% and the first instance has actually turned out to be lower than what was probably the rhetoric a few months ago during the elections. So to that extent, there too, there has been a climb down. So I think we need to keep some of these realities in mind and not necessarily jump to conclusions, especially from a portfolio standpoint. We would probably not, we are not trying to preempt anything here. We continue with liking some of those themes that were more domestic specific, which were important. And there were certain areas where we felt that irrespective of whatever happens to tariffs, India should be kind of okay, and perhaps in fact have an opportunity to even increase market share in the global scheme of things. There we have persisted, and we have maintained our conviction. I think some of the new emerging areas which come about because of, let's say, Mexico plus one or a Canada plus one kind of a situation is something which we would not want to necessarily jump into without seeing before seeing the reality on the ground. So there we don't have a choice but to keep holding our horses.
Right, Tahir, but on that note, do you believe that this trade war that is only expected to escalate would now make it would turn India once again attractive for FIIs, because the kind of outflows that we have seen, they've been unprecedented so far. Do you believe that this trade war could turn out to be beneficial for India from an FII standpoint?
I think at overall level, there has been this expectation in any case that India would not necessarily be in the thick of the crossfire. We would probably have some impact, and more so coming out of the fact that global growth may slow if some of these trade escalations or trade wars were to escalate. So I think that scenario still remains, but I don't think there was in any case that expectation that India would be severely punished in this regard. So I think that is not necessarily the case, but there could be along the way, as I said, some opportunities which may come about for India, and but it's better not to preempt if at all, and try and just watch the game from the sidelines at this stage. I think for the US also, it is not easy decision making. While there could be a little bit of the political rhetoric, and we also know what are the other considerations. I mean, if for example, US is relenting on some of the, or likely to relent on some of the tariffs, they are trying to essentially bargain and get something else for themselves out of these countries, which is also maybe intangible, but it is important to them. So I don't think we should, mix up economic considerations and other considerations at the same time. So India, to my mind, FIs will return if we see generally the situation. It will be a function of larger cyclicalities where India starts getting back into a scenario of upward revision to earnings. Dollar settles down as a currency, especially after the trade war related stuff. Emerging market currencies stabilize and move upwards. And I think if that scenario were to probably develop, then that is probably going to be the larger reason for FI flows to once again start looking more positive compared to what it has been in the course of the last 6 months.
All right, Taher, with this, we'll let you go on that. Really appreciate you taking the time out and speaking with us.